We know we've got to look for the badge. We know we're going to have reasonable questions asked. We need relevant time to get it. We know where we're following. We know if it's a criminal or not. We know the rest. But now what happens? How much info? How many years do we have to give? How much information do we have to give SARS? And for which periods? Can they go back 5 years? Can they go back 10 years? Can they go back 15 years? Can they raise assessments for more than 5 years? Can they raise assessments for 15 years? What can they do? What is the process? Now we need to know this up front. Because it doesn't help when a SARS says SARS saying we're coming to do a field audit, and they want to do the field audit from 2007, Feb 2007, to February 2014. Why? 5 years. You can only go back 5 years, SARS, unless you can prove there's misrepresentation, fraud, material non-disclosure, all the rest. So why are you, as the practitioner or the payroll manager, going to give SARS that information? Because you're just opening up prescription. You're opening yourselves up to audit, all right? And we're going to run through that process now. I'm going to take it slow, and then we can have a look. One question. You ask any payroll manager, how many years documentation do you have? And they will tell you, on average, 15 years. Correct? The fact that it's been for the last 14 years in the bottom basement, that nobody's been into since 10 years back, and it's been flooded 3 or 4 times, you still got the info, but it might be a little shrinkled up. Or you sent it to Metrofile, and somebody drove the forklift into your section and is now all mixed up or whatever. You know, so we've got to be careful when we say how many. You're only required in terms of 5 years. So let's look at what it said before we had the Tax Administration Act. Okay? What about documents? Paragraph 14.1 of the 4th Scheduled Act provides as follows. Every employer shall in respect of the employee maintain a record showing. Now this is important, because this is information they can request from us. A, the amount of remuneration paid or due by him or to her to such employee. What's that? That's gross remuneration, guys. That's where everything in place. The amount of employees tax deducted or withheld from the amount of remuneration contemplated in A. And C, the income tax reference number of that employee where the employee is registered as a taxpayer in terms of Section 67. Now let's stir a bit. How many of your recons have been rejected because you don't have tax numbers? Lots. How many there is saying default, you don't have a tax number? What does the Act say? And it still says that. Point C, the income tax reference number of that employee where that employee is registered as a taxpayer in terms of Section 67. So if the employee is not registered, do you have to put it in? No. Only where the person is. But does e-filing allow that? No. Once again, it's their own interpretation. We will reject it because you've got to make sure. You've got to be the policeman and go make sure every one of your employees is registered. But that's not what the Act says. Okay? Once again. And D, such further information as the Commissioner may prescribe and record such records, and such records shall be retained by the employer and shall be available for scrutiny by the Commissioner. Right. That's what Section 14.1, that was your obligations in terms of what you need to hold from a document retention perspective, and also at the end of the day, what you need to keep available for SARS. Does that talk about policies? Does that talk about letter of appointments? Does that talk about anything that SARS asks for in that aspect? The answer is no. But then we have D, which is always the issue. Such further information as the Commissioner may prescribe. So in other words, the Commissioner can come and say, can we have your policies or whatever. It's such a wide area, but that's what Section 14.1 still says today. All right? However, no period of retention, this is now before tax administration, no period of retention is specifically referred to in terms of paragraph 14 of the 4th Schedule to the Act. Now, what does retention mean? How long do you have to keep documentation? We all know there's certain periods for company docs and, you know, those kind of things, but what about PYE? It never stated that. The only thing that did state that was paragraph 30, which provides, that was under your offences, all right, which has now been deleted. Said, paragraph 1I said, any person who fails or neglects to maintain any record as required by paragraph 14 or retains such record for a period of 5 years from the date of the last entry therein or furnish to the Commissioner any declaration as required by the paragraph shall be guilty of an offence and liable to conviction to a fine or imprisonment for a period not exceeding 12 months. Okay, what does that tell us? 5 years from the date of the last entry therein. So for payroll purposes, what is the last date of entry? When you hand in your reconciliation, correct? Because we've done monthly, we calculate, pay over our 201, and then our final declaration is in fact our IP5 reconciliation, balancing between what we've paid and what we've shown to be for the employees. That's our last entry, which according to 2014 tax year was when? The 31st of May. Okay. So, in other words, 5 years from the 31st of May is 31st May 2019. We have to keep those documents for that 5-year period. That's what the Act says to us. That was in the past, and it stays the same when we go into the new Tax Administration Act. So in other words, when SARS asks us the question, how many years documentation do you have? Your response is 5 years. Can they conduct an audit exceeding the 5-year period? The answer is no. Until they prove to you, and we'll get to that later again, there's been misrepresentation, fraud, or material non-disclosure. Right, so we always got to keep that in mind. 5 years. Right, that was before. Still on that aspect. For purposes of determining the date of the last entry, one would take the submission of the annual 501 reconciliation. The recon supports 12 periods of tax year submissions, 201, and confirms the correctness of the amounts deducted and paid over. Right, so we know that now. 5 years. But every single time you make a change to that declaration, that 501 declaration, that 5-year period is extended. And that's something we've got to be very careful of. You know, then you've got the director coming along saying, oh, last minute change, you need to change my travelling allowance. It wasn't high enough. Do you know those kind of, you've heard those requests? Every time you make that change and you resubmit that 501, you are extending that 5-year period. Because the last entry thereon is effectively then that specific date when you change it. So you have to be careful of that. Is everyone following us here? Okay. Then the next one. Yes, sir.
So if that change is initiated by SARS?
If the change is initiated by SARS on the reconciliation at the end of the day, it's still the last entry. So in other words, you are still extending that. Now, circumstances where that could be initiated by SARS is saying, well, you've incorrectly done your reimbursive coding as 3702. It should have been 3703. Redo all your stuff. That's the kind of thing that comes through on that. The answer is still, you extending that even though SARS forced you to extend it. So it's 5 years from the last date of entry therein. Okay. That was before Tax Administration Act. From the 1st of October last year, what are we at 2012? Section 29.1. Look guys, you don't have to know all these sections. That's why I've kept it in here, so when you do get bored one day, or you suffer from insomnia, you can actually go and have a look here and pull the Act out and see what I'm referring to, okay? So it's not my own opinion, this is what the Act says, right? 29.1a, a person must keep records, books of accounts, or documents that, A, enable the person to observe the requirements of the Act, which is what? Paragraph 14 of the 4th schedule, which says income tax number, gross remuneration, okay, and B, are specifically required under the Tax Act or by the Commissioner by public notice, enable SARS to be satisfied that a person observed these requirements, right? So that's what it says to us in the new Tax Administration Act. Further, Section 29.2 provides as follows. The requirements of this Act to keep records, books of accounts, or documentation for a tax period apply to a person who has submitted a return. A, has submitted a return. What's that? That's income tax at the end of the day. That's when you submit a return. And what is a return? For a specific tax period. Did I skip a page there? Not. Okay. Right, so that's when you submit the return. 201 for a tax period. What's a tax period? A tax period is defined as means in relation to a provisional tax or employees tax, skills, development, Section 3, constitute determined in section whatever. Okay, I'm not going to read all of that, but basically a tax period is when you hand in your return. Okay, so that's a tax period. Okay. For purposes of paragraph 2.1 of part 2 of the 4th schedule, the employee is required to submit a return reflecting the amount of employees' tax deducted or withheld within 7 days at the end of the month in which such amounts have been deducted or withheld, being the tax period referred to in section 29.2a. Now this is very important. In the past, it said the last date of entry, which would be our reconciliation. In terms of Tax Administration Act, they're talking now about tax periods. So now we're no longer just talking about the reconciliation, we're talking about your monthly return. So it can be in certain circumstances that your recon falls still within the 5-year audit period, but some of the months within that tax year no longer fall within the 5-year period. Are you following what I'm getting at here? Because that changes the position once again. And this is something we're going to look at now, which is important in the bigger picture of things. Okay. Okay, for purpose of annual IP5, we know that employers shall, by such dates or dates prescribed, submit those. Section 29(3), records, books of account or documents used to be retained by persons described after a period of 5 years from the submission of that return. Right, so, same thing, 5 years, but now they're talking about the submission of the return. So that's the only time we have to keep documentation. Do you understand the significance of this? It is very important. Before you even enter into a field audit or entertain a request for relevant information and all the rest of it, you need to go back and say, the period that is the information's been asked for, do I still need to have kept the documents? Because if I don't have the documents, what can SARS do? Can I do an estimation? No. I didn't have to keep the documentation. So you first got to come tell me there was something actually wrong, and then we can discuss it. Please don't make the mistake of saying, I've got the information available. It doesn't always work like that. Are we going to take a break now? I need one. Okay. You all survived that? Just barely. You're getting your CBD points, so the punishment's still in place. Oh yes, your questions. You know that 1 to 20 questions you have to complete? Have you got them already? Pretty straightforward, just run through the process. You know, unfortunately, that's one of the requirements from site. Like the Law Society, they will believe you if you tell them that you come to the workshop. It's just different organizations. But anyway, that's done, and you can complete online. I can't tell you the answers because you see it's on webinar this time. No, but it's pretty straightforward. If you run through the process, you'll just pick it up. It's done. It's just to add to the qualification requirements. Right, so if we go back in, just finishing off with this tax administration document retention, before we get to those notes that you've now received will be sent to you electronically as well, okay? It should have all been in the folder, and for some reason it wasn't. And unfortunately, you guys are my first, so I didn't see it until this morning. All right, so they quickly made copies for us, but it will be sent to electronically, and it's going to be sent to the guys on the webinar too in an electronic format, okay? But we'll get to those because those are the last lot in our notes that we're going to run through. Some interesting things there. Right. So obviously we know the 5 years is from a return perspective at the end of the day, and that's it. There's only one difference though that we need to bear in mind. Although we are required to keep documentation for only 5 years, if we are busy with an audit or objection and appeal, we have to retain those documentation until the conclusion of the audit, objection and appeal. Okay? So that's one thing you need to bear in mind until it is finalized. Why was that brought into effect? Because of the old days, you know, we play games. And yes, we carry on with SARS with the audit, and eventually we get to a letter of findings and we say to them, but sorry, I don't have the proof anymore. Because 5 years has elapsed since you started the audit for those periods, so you can't raise an assessment because I don't have proof. And I'm not obliged to keep the proof because 5 years is gone. So we can also pull dirty tricks every now and again, okay? So they stop that trick at the end of the day, meaning you have to keep your information while the audit is underway, the objection and appeal. Okay, but now this is very important. We need to, before the audit commences, determine what the period is, and at that stage we need to tell SARS we do not have that documentation anymore because of the fact that 5 years has prescribed. Because once the audit's underway, it's too late. We can't then turn around and say, but we only need to keep the documentation for 5 years because Section 32 provides that we have to retain that documentation. So please bear that in mind, because this is where the next is the most important aspect. Period of limitation for the issuance of assessments. Right? The provisions of Section 99(1) of the Tax Administration provides as follows. SARS may not make an assessment in terms of which in terms of this chapter, in the case of self-assessment in which a return is required 5 years after the date of assessment of the original assessment by way of self-assessment by the taxpayer. Now what does that mean in English? Okay, it means SARS may not raise an assessment 5 years after the date. We are now sitting in October. So what are we going to hand in on the 7th of October? Our September 2014, 501. I mean 201, sorry. So if we go back 5 years from this date, what are we talking about? September 2009. That's our cutoff. So SARS may not raise an assessment prior to September 2009 based in terms of Section 99(1). Are you all following what I'm getting at here? So why, if you want to come and conduct an audit at my premises, do you want to do it from 2008? Because you're wasting my time and your time. Because even if you found anything, you can't raise an assessment. Section 99(1) says no. However, this is what we've got to be very careful of. Section 99(2) says that subsection 1 does not apply if they can prove fraud, intentional or negligent misrepresentation, 3, intentional or negligent non-disclosure of material facts, 4, the failure to submit a return, or if no return is required, the failure to make the required payment of tax. So only in those 4 circumstances can SARS go back more than 5 years. But if they are starting the audit, can they prove any of that? Can they prove there's been fraud? They haven't looked at anything yet. Can they prove misrepresentation? The problem that we have is, what is negligent non-disclosure of material facts? What is defined as material within the Income Tax Act? 1 rand, 10 bucks, 100 rand. There's nothing that tells us what is deemed material at the end of the day. So by the commencement of the audit, we need to go back and say, SARS, we're happy to entertain you, but bearing in mind our 5-year documentation retention means we don't have any more documentation of before the period of September 2009. We are happy to oblige to give you that info. Are you following? Is it sneaky? Is it law? So what's the problem? Is it not like your kids at home? 10 o'clock's curfew? Or more? Eh? Same aspect, you push the boundaries. But what I'm trying to get at here is, don't open yourself up for things that you're not going to be able to effectively defend at a later stage. This is what you're required to do. 5 years documentation. That's all you need to keep in mind. Can SARS issue an assessment older than 5 years? The answer is no. Bearing in mind, even though, and this is something that we'll be finding in practice, and if you have a problem, I can't give you the taxpayer's name, but I can confirm the precedent has been created already. You started an audit in 2012 for one of our clients, going back to 2008, okay, which was in the 5-year period. They only raised the assessments last month, but they did not raise the assessments for periods older than 5 years. Why? Because they're not entitled to do it, because they cannot prove those last elements. So even though we had to keep all the documentation from 2008 while we're busy with this audit and going into the objection and appeal, they have not raised those assessments because they're not entitled to do it in terms of Section 99(1). You following what I'm getting at here? So you want to be even more sneaky now. I'm not teaching you guys the wrong things here. Extend the audit as long as possible. Because the longer the audit takes, the more periods you're chopping off in terms of that assessment. So if you don't, remember I told you they have to give you a progress report every 30 days? If you don't want to push the matter, don't ask for the progress report. And so the matter drags and drags and drags, and eventually the assessments are prescribed. So even if you found something, you've got to prove still then it was intentional misrepresentation or negligent misrepresentation or material non-disclosure of facts. Have I taught you something new today? Is it sneaky? Most definitely. No, the point being is, if we follow what the protocol of the law says to us, we're within our rights to do exactly what we are doing. And what does that mean? Do you know the significance of being able to knock off an assessment purely on the basis they're not entitled to raise that assessment? If we go back to what penalties and interest, in terms of the additional tax and all the rest of it that used to be in place, now it's changed by understatement penalties. But just take the amount of interest that you are saving by effectively going this route and saying, sorry, 5 years has lapsed, you may not raise an assessment. That's your biggest killer. Because the capital is fine, but 5 years of, well, we're talking from 2008 to now, how much? 7 years of interest. We're nearly getting to the duplicate amount of the capital that's outstanding. Okay, so it's very important to follow these protocols at the end of the day. So now we've covered what happens when they come visit you. We've covered how do you make sure you keep within your 5-year period. What can they raise assessments for? What they cannot raise assessments for? How they have to disclose to you. Make sure that there is reasonable grounds at the end of the day. If any of you